This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Well, hello, Sammy. Thanks for joining us on Investor Connect. Glad you could be here today, and just wanted to talk more about Blossom Street Capital and what you guys do there.
Yeah, I appreciate you taking the time.
Great. You're based in Dallas, and in talking the other day, I found you had a pretty interesting investment thesis, and just wanted to learn more about what you guys invest in and what you're looking for. I looked at your portfolio and thought you had some interesting deals in there as well. You know, spread around the country. It's not just in one place, and across many different sectors.
Yeah, I appreciate that. So we are generally a Series A investor. What we really focus on is the quantitative aspect of any business. So I care a lot more about revenue growth, cash burn, cash efficiency, valuation than I do about what the founders have done in the past, what the size of the market is, what the IP is. All those kind of qualitative factors to us are just a bonus. For us, it starts and ends with the numbers. So we're a numbers-focused investor. We do not have an industry thesis. We do not have a geography focus. If I can understand the business, we'll take it to committee. We'll look at it. One thing we also do as well is we focus on special situations. So to us, a special situation can mean anything. It could be the company is based in a city where there is not a lot of capital. So it could be a Detroit, Kansas City, even a Dallas. It could be a situation where the founder went out, tried to raise money at a very high valuation. Market said no. And now he needs to get money in quickly because his back's against the wall and needs to raise. We look at situations like that all the time. We do inside rounds, we do down rounds, we do restructuring. So we do like stepping into situations that perhaps require some creativity, perhaps require something to be fixed, either on the balance sheet or the cap table, or just, extending the life of the business, a stretch round, a continuation of an existing round. Those are the types of situations we also do, just to avoid kind of the valuation trap that we see out there in VC.
And what kind of revenue does a company have to get on your radar?
For us, it's $100,000 a month. It depends on the business model. So for recurring revenue business, $100,000 is where we like to be. If it's a non-recurring revenue business, maybe it's an e-commerce business, we generally want $300,000 a month.
Okay. And so you had some good deals out there. Which of the deals you think really typify or give us like an example of one of them that really fit your model and why?
Yeah, so if you look at our portfolio, it's all over the place. We've got software. We're in the greeting card business. We've got a parking app. We've got an old school dating business that has matchmakers that tell you why you're bad at dating, help fix your dating life and set you up on dates. Our portfolio, the only thing the companies all had in common was the numbers were interesting when we invested. So that is the approach we take. For instance, we've got Love Pop greeting cards. They were a Shark Tank company. It's a greeting card that opens up and it's more of a sculpture. We've got Spot Hero. Spot Hero is a parking app that helps you find, reserve, and pay for parking. They just did a large $30 million round led by Insight Ventures. We've got a number of software companies, Attentive, Sendify, DVHQ, kind of all areas of software. So no particular industry or vertical focus there. So for us, it really does come back to, all right, what are the numbers? What's the valuation? Can we understand the business? Great. Let's look at the opportunity.
And do you lead the deals? Do you follow deals? Do you syndicate or all of the above?
All of the above. We prefer to lead, but we can also follow or tack on.
Okay, great. And have you had any exits so far?
We have. We had an exit out of Detroit called Level 11. It was a good win for us. Our portfolio right now is 12 companies, about to be 13. What I would tell you is, gosh, of the 12, 2, I would say, give me frequent headaches, trying to right the ship there, so to speak. The other 10 are at various levels of good to fantastic. We are still a very young fund. We started 4 years ago. One kind of material exit on paper. One material exit. The rest of the success is on paper. So we have as much to prove as any entrepreneur does that's a first-time entrepreneur. So, as a fund, we are looking for exits and looking for ways to kind of grow our brand, grow our business, and exits will hopefully be a big part of that, in 2017 and even 2018.
So you got a good fund there. Is that a committed fund or is that a pledge fund, or how do you guys work with that?
Yeah, so it's committed. So what we do is we raise a fund every year, committed capital. It sits in a bank account. It's committee controlled, but we raise small funds. So total AUM across our 4 funds is $9 million. The last fund was $3.5 million. Of that 3.5, we've got about 1.5 left to invest. And then we're going to be back out fundraising probably Q4, Q1. So we're very different from other VC in that we do not raise a 5-year or 10-year fund. We raise a fund every year, deploy it in the same year. That's our model.
It sounds like it's halfway between a pledge fund and a large-scale committed fund. You have committed funds, but you're getting the funds for every 2 or 3 deals and then getting more money for the next 2 or 3 deals. Is that how it works?
No, I would not call us a pledge fund. We are a full-on committed VC. We raise for 4 deals, which is a year's worth of deals for us. So, for instance, if we raise that in January, the goal will be to deploy that across 4 deals, 1 deal a quarter through December. And then we raise again from our LPs. Our money is not a called capital structure, right? Once we raise the money, or when we raise the money, we literally take signed docs and a check or in a wire same time. So the money's sitting there in a bank account, fully committed, fully funded. There's no need to call capital.
Okay, so you have the funds ready to go, so when it's time to write the check to the entrepreneur, it's ready to go. There's no wait and see if somebody else approves. It's a done deal.
Correct.
Okay, that sounds great. And how did you come up with that investment thesis? What leads you to it? There's a lot of market dynamics out there, I'm sure, but what is that?
Yeah, I mean, look, we don't think the world needs another conventional VC fund, either from the investor perspective or from the entrepreneur's perspective. I think from the investor perspective, the old model of 2 and 20 fee structure with a 10-year fund is broken. It's just very expensive. The money is tied up way too long, and it's committed for too long a period. So, we think it's antiquated. We think that model is going to die. From an entrepreneur perspective, we think there are a lot of very good companies out there that are just overlooked. But they're not in San Francisco. They're not in New York. They're not in Boston. They're in Detroit. They're in Kansas City. They're in Houston. They're in Tulsa, right? They are companies that, perhaps they've got an issue in their history that they've overcome. They are a special situation of some sort, right? We like to shop in the scratch and dent aisle. So if it's a company that's growing, 2-3x year over year, it's based in San Francisco, we're just not going to be a fit. There's plenty of VC out there that fit that mold. We are looking for companies that have done well, perhaps have overcome a pretty meaningful challenge that, maybe even scared other investors away. That's a great situation for us. That's the kind of opportunity we want to look at.
Well, there are many geographies that are underserved. So how do you source deals across so many geographies? Are you on the plane 24/7, or how do you guys do that?
It's an outreach program. We cold outreach. I reach out to, probably, few hundred entrepreneurs a day, introducing ourselves or following up with email, right? I mean, I'm in Dallas. We're a small fund. Nobody knows us. Battery Ventures is not calling up Little Blossom Street to come fill out their round, right? So as a result of our geography, where we are, who we are, our relatively young age, we reach out to entrepreneurs every day and just introduce ourselves and just try to get on their radar so that when they are raising, or if we do happen to reach out to them while they are in the midst of a kind of a special situation financing, we get lucky and, there's something we can explore.
Right. Well, I've read some of your blog posts, and it looks like you do quite a bit in the world of data analytics, a lot of analysis on fast companies and multiples and those type of things. What's your take on data analytics, and what are your best practices there?
Yeah, I mean, for us, the numbers are the most important thing, right? Everybody has a good story. Everybody's got an interesting story. Everybody's got an interesting business. If you have managed to raise money in the past, you convince somebody that you're interesting. For us, we block a lot of that out, right? So I want to look at your numbers. Where is your revenue growth? Who are your customers? What kinds of contracts do they sign? What's your churn like? What's your net retention like? Are you profitable at the unit economics? Are your unit economics profitable? Right. So we spend a lot more time with the numbers than anything else. Does the founder own enough equity? Do we need to step into a situation where we create a larger than average option pool to re-equitize the founders or the team managers? So for us, it's all about the numbers and the data, the qualitative. It's just not for us. We're not savants, right? I don't know if autonomous cars are going to work. I don't know if blockchain and Bitcoin is going to be the way that we all transact in the future. I don't know if 3D printing is going to be something that's material. And I don't know where AI is going, right? There's all of these buzzwords, all of these hot spaces. Well, what's hot one day isn't hot the next, right? Subscription box was hot for a while. I would argue subscription box is in a lot of trouble. 3D printing, everybody thought it was the next big thing. Well, we haven't yet figured out, what is the mass at scale contribution to society that 3D printing is going to provide, right? So we are not qualitative guys that have some big thesis about the particular industry. We're numbers guys. And so for us, it starts and ends with the numbers, because the numbers tell us the real story as to whether or not you're building a real business or,
So if you go purely by numbers, you could, there's no qualitative information in there that goes with that. And so at some level, a data-driven decision could make a bad decision because, their numbers happen to be pretty good for now, but they were in the wrong industry or what have you. How do you avoid a situation like that where you're looking only at the numbers?
Yeah, you really don't, right? We do look at, I care about what the business does, right? Qualitative is meaningful. We're not going to jump into something that, quantitatively looks good but qualitatively doesn't. But I'll tell you this, very rarely you find a situation that quantitatively looks good but qualitatively it doesn't, right? Usually the numbers prove to you that the qualitative side of the business is real and that there's something there. So we don't see too many situations like that, frankly, where you've got what looks like an ugly business but really good numbers, or you've got what looks like a beautiful business but bad numbers. Those things usually don't mesh. So while we don't see it often, there's no real answer to your question, Hall, right? I don't know. We very well could be wrong. Our thesis might be totally flawed. And, what I would say is ask me in 3 years, and I'll tell you whether or not it works, right? Hopefully a lot of the success we're having on paper translates into exits, or maybe it doesn't. Maybe we're just wrong. So I think it's still yet to be seen whether or not a quantitative approach is going to work in VC, but it is the approach we are taking.
Well, it sounds like you're finding good deals out there. Are you thinking about raising larger amounts of funds to do more deals or to help these companies along faster?
We will raise larger funds, but we won't, there's a limit. I do not want to step out of kind of that Series A realm. We think the opportunity is in Series A. We think there's way too many players in seed. There's way too many players at the Series B, Series C level, right? So I want to stay in Series A, and I don't ever want to get to the point where we raise a fund that's so big where I have to bleed into Series B, Series C, or maybe I have to go to seed because I can do many more deals at a much faster clip, right? There's a lot less diligence to do at the seed stage, or there's a lot less you can diligence from a quantitative perspective. So, yes, we will, hopefully raise larger funds, but I don't see us raising more than, call it, 15 to 20 million in a year. Granted, if you're raising 20 million a year, that's the equivalent of $100 million fund, because most funds raise enough capital for 5 years. So if you raise for 5 years, you raise 100 million, that's 20 million a year that you're deploying, right? Us, I'm not going to raise all 100 million up front. I'll just raise 20 million each time. It's just a much more investor-friendly structure. So yes, one day we will raise larger funds. We are not there yet. We still have a lot to prove.
Great. Well, I understand the value of the Series A. The seed is quite risky. It's just hard to pick the winner out among so many players in that case. And Series B and C, the valuations get so high up there, it's hard to see how that's going to return back. And Series A appears to be the sweet spot from what I'm hearing you say as well. Are there any other reasons for Series A?
I think there are not as many funds. I think you just called it, right? There's not as many funds that are interested in writing $1 million check at a time. At the same time, there's not a whole lot of angels that, or even seed funds that would write, call it $1 million check. So if you can write $1 million, maybe even $2 million check, there's a lot of interesting deals out there that you can see and that you can fill. That's our view. Gosh, one day the Series A might get crowded. And then, maybe the Series B lightens up, or maybe even the seed gets more attractive. But for now, our view is there's plenty of capital at the seed stage, a fair amount of capital at even, pre-seed. There's a lot of capital at the Series B and C level, and, frankly, I can't raise a big enough fund to deploy at that stage. So in our view, there is, at least for now, somewhat of a hole in the Series A where it's companies looking for, call it $500,000 to say $3 million in an underserved geography, or that has an inside round, or they just want to do a very fast round and just close it and not go out and optimize for valuation. Right? We do think there's an opportunity there, at least for now. One day that window's probably going to close, but until it does, we're going to invest into it.
Yeah, I see a lot of funds raising a lot larger amounts, $100, $200 million, but that kind of pushes them out of the $1 million companies. Now they're asking for $3 to $5 million revenue companies to start to engage. So they've left a lot of low-hanging fruit down below that because they've got such a bigger fund, or they're trying to speed up the process in some way by getting later stage deals if they can.
Yeah, I mean, look, if you raise a $100 million fund, writing a $1 million check, that's probably not very interesting. You're going to have to do 100 deals, which is hard. So, yeah, I mean, as guys raise larger funds that are, 9-figure funds, lower 9-figure, maybe even 8-figure, they can't afford to write a small check. It just doesn't make sense for them from a resources standpoint.
That makes sense. Any other comments about your process or program or what you guys do there?
No, look, I think your questions were great. We were able to talk about it pretty thoroughly. My email address is sammy@blossomstreetventures.com. It's on our website. We're kind of the anti-VC in that I love a cold email that's inbound to me. You do not need a referral. Reach out. Gosh, I guess that's really it.
That's quite a change as well. Most people require referrals and references and secret handshake and whatever else. And here you just can take an email and they can be talking to you straight away. That's quite fantastic. So appreciate your taking time to share that with us today. We'll include your email address on the show notes and let people know more about what you guys are doing there, and hopefully send more deal flow your way as well. Thank you so much for taking time.
Oh, thank you. Very much appreciate you taking the time as well.